The Japanese yen just hit a wall, plunging to a 3-week low against the US dollar, and the reason why is a fascinating lesson in how markets react to economic data. But here's where it gets controversial. The yen's decline happened even after Japan released inflation data that was, on the surface, slightly better than expected. This paradox is at the heart of the currency's current struggle, revealing that traders are looking far beyond a single headline number. The Japanese yen JPY continued its slide during Friday's Asian trading session, failing to find any support from the latest domestic consumer inflation report. To understand this, let's break down the numbers. Japan's headline National Consumer Price Index, CPI, actually cooled off in July, easing from its previous level. Compounding this softer data was a separate report showing a fall in exports for the third consecutive month. For a beginner, think of it like this. If a country is selling fewer goods abroad, exports, it brings in less foreign currency, which can weaken its own currency's value. And this is the part most people miss. Domestic political uncertainty in Japan is now a major factor. This instability is leading many experts to believe that the Bank of Japan, BoJ, might be forced to delay its plans to normalize monetary policy, that is, to move away from its long-standing ultra-low interest rates. This expectation that interest rates will stay low for longer is a fundamental reason the yen is struggling to attract buyers. However, digging deeper into the inflation report reveals a critical silver lining. The core CPI reading, which excludes volatile fresh food prices, remained stubbornly high and even came in slightly above what analysts had predicted. Even more importantly, the core CPI, which strips out both fresh food and energy costs and is the BoJ's preferred gauge, showed a significant increase. This sticky underlying inflation, combined with strong wage growth that could boost consumer spending, keeps alive the possibility of a BoJ interest rate hike by the end of the year. This complex mix of data offers a fragile floor of support for the yen, preventing an even steeper collapse. Now, let's talk about the other side of the equation, the US dollar. The USD's recent rally paused as traders adopted a wait-and-see approach ahead of a highly anticipated speech by Federal Reserve Chair Jerome Powell at the Jackson Hole Symposium. This caution among dollar bulls is helping to put a lid on any massive gains for the USD-JPY pair. But here's a thought-provoking question. Are markets getting ahead of themselves by betting so heavily on US rate cuts? Recent US economic data tells a nuanced story. While jobless claims rose significantly, hinting at softening in the labor market, and a key manufacturing index plummeted, renewing fears of an economic slowdown, these are just a few data points. This data has led traders to price in a high probability that the Fed will start cutting rates as soon as September and do so twice before year-end. Powell's upcoming comments will be scrutinized for any confirmation or rejection of this dovish narrative. And his words are guaranteed to cause significant volatility for the dollar and the USD-JPY pair. From a technical trading perspective, the USD-JPY pair's overnight surge past the 148 mark was a major event. This level represented the ceiling of a trading range that had contained price action for 3 weeks. Breaking through it activated a wave of buying, and technical indicators suggest the momentum could very well continue upward. The next major target for bulls is the 200-day simple moving average, which sits just above the $149 level, with a potential run toward the key $150 psychological barrier after that. On the downside, any dips are likely to find buyers waiting near the $148 level, which has now flipped from resistance to support. So, what's the final verdict? The yen is caught between disappointing headline data and hopeful underlying inflation signals, all while political uncertainty looms. The dollar is pausing its ascent as the market holds its breath for guidance from the Fed. But we want to hear from you. Do you believe the market is right to bet on imminent Fed rate cuts? Or is this optimism premature given lingering inflation concerns? And is the Bank of Japan truly ready to hike rates? Or will political pressures force them to remain accommodative for much longer? Share your analysis and opinions in the comments below.